If you've ever been told to form an LLC the day you start invoicing, you were handed advice that skipped the math. The moment you accept money for work as an individual, you are already a sole proprietor. No paperwork, no fees, your business income lands on Schedule C of your personal tax return. The downside is simple: there is no legal wall between the business and your personal life. A lawsuit against the business can reach your savings, your home, everything. An LLC is a legal entity that exists separately from you. File articles of organization with your state, pay the fee, and that wall goes up. A judgment against the business can no longer reach your personal accounts. You also unlock the S-Corp tax election later, which becomes significant at higher income. The trade-off is real ongoing cost, state filing fees, annual reports, and the discipline to keep business money strictly separate from personal money. There are exactly two reasons to form an LLC. First, your business has real liability exposure. You give professional advice, work in client homes, handle other people's money, or have personal assets worth protecting. Second, your net profit is consistently above $80,000 a year, and you want to access the S-Corp election. If neither applies, the LLC is mostly a fee. It does not save you on taxes by default. It does not change how you operate day to day. At $60,000 of net profit, a sole prop and a single-member LLC pay almost identical taxes. The LLC just absorbs its own annual fee. The math changes at $100,000 of profit with an S-Corp election. You pay yourself a reasonable salary, pay payroll tax on that, and take the rest as distributions with no payroll tax. Net savings roughly $3,000 to $5,000 a year, minus $1,000 or more in extra accounting. Below $80,000 of profit, the overhead absorbs the savings. The most expensive misconception is that an LLC saves you on taxes. By default, it does not. Pass-through treatment is identical to sole prop. The tax savings come from the S-Corp election, which requires meaningful profit to justify. Sole proprietors also take the same business deductions on Schedule C. The deduction list does not change when you form an LLC, and the LLC does not protect you from personal negligence or fraud. It protects you from contract disputes and ordinary business liability. The decision tree is short. Stay sole prop in your first 2 years if your liability risk is low and profit is under $80,000. Form an LLC when real liability exposure exists, when you have personal assets worth protecting, or when you're approaching the S-Corp threshold. Elect S-Corp once profit is consistently over $80,000 to $100,000, and you can afford an accountant to manage the added complexity. Most successful freelancers start sole prop, switch to LLC in year 2 or 3, and elect S-Corp in year 4 or 5. Nothing has to happen on day 1. Whatever legal structure you choose, the structure only decides what gets reported on April 15th. What happens to the money the moment it lands is a different problem. Tax comes off the top. Bills get covered first. Your reserve builds before you spend. Able runs that cash flow layer whether you're a sole prop, filing Schedule C, or an LLC with an S-Corp election. The legal question and the cash flow question are separate. From unable to able. Try it free for 30 days at becomeable.app.